2008 redefined the global financial landscape forever. A crisis that toppled giants, wiped out trillions in wealth, and reshaped how we understand money, risk, and trust. But what if you had truly understood money before it all fell apart? What if the warnings, buried beneath the surface of soaring markets and easy credit, were clear enough to change your financial future? In the early 2000s, confidence in markets was near unshakable. Housing prices climbed steadily year after year. The idea that real estate could only go up became almost gospel. Banks, investment firms, and everyday investors alike believed that financial innovation had tamed risk. Complex mortgage-backed securities and derivatives were thought to spread and reduce risk, not concentrate it. The economy appeared resilient. Growth was steady, unemployment low. Central banks kept interest rates low, fueling borrowing and investment. The prevailing belief? Markets were efficient, risks were manageable, and prosperity was within reach for many. What actually happened? Behind this calm surface, cracks were forming. Banks extended mortgages to increasingly risky borrowers, subprime loans, with little oversight. These loans were bundled and sold worldwide, masked by layers of complexity few understood. When housing prices stopped rising, defaults surged. Financial institutions found themselves holding toxic assets they couldn't value or sell. Liquidity evaporated, and confidence plunged. Major banks faced insolvency. Lehman Brothers collapsed. Others were forced into government bailouts. Markets froze. Credit stopped flowing. The economy contracted sharply, pushing millions into unemployment. The crisis was indiscriminate in its destruction, yet its aftermath revealed stark contrasts. Homeowners who had over-leveraged found themselves underwater, losing homes and savings. Middle-class families faced the brunt of unemployment and reduced access to credit. Small investors saw retirement accounts plummet, shaken by market volatility. Conversely, some hedge funds and investors who anticipated the collapse profited significantly by betting against the housing market. Large banks that survived did so largely due to government intervention, raising questions about moral hazard. Meanwhile, regulatory agencies were criticized for their failure to foresee or prevent the buildup of systemic risk. One lesson stands out. Risk cannot be fully eliminated, only understood and managed. Blind faith in rising asset prices is dangerous. Markets are cyclical, not linear. Complex financial products require transparency, not opacity. Debt-fueled growth amplifies vulnerability. Trust in institutions must be earned and scrutinized continuously. Perhaps most importantly, understanding the psychology behind market behavior, greed, fear, herd mentality, can be just as critical as analyzing numbers. Today's investor must approach markets with a clear-eyed understanding of history and human behavior. Diversification is not just a buzzword, but a shield against unexpected shocks. Due diligence goes beyond surface metrics. Digging into the underlying fundamentals and risks is essential. Recognize that central bank policies, while stabilizing in the short term, may sow seeds of future imbalances. Financial literacy is a lifelong pursuit. No one can predict crises perfectly, but preparation and humility improve outcomes. The 2008 financial crisis was inventive and truce. The complexity and fragility of our financial systems. It revealed the limits of human knowledge and the dangers of complacency. Yet it also offered invaluable insights if we choose to listen. For the thoughtful investor, these lessons are a foundation, not a fear. Understanding money through time, psychology, and market behavior equips us to navigate uncertainty with greater confidence and resilience, not to chase certainty, but to respect risk, not to follow the crowd, but to think independently, and in doing so, to move back to better.